get 8 to 10 case studies of 5 marks each in BFM. Roughly 8 case studies you get at least. So even if you consider 8 case studies, you'll be having 40 marks. Plus, you get one line numericals around 10 to 15. One line numericals, single line numerical means 1 mark numericals. So you get around, I'll tell you, 55 to 60 marks of numericals in BFM. That is the importance of numericals in BFM. Okay. So that's why we'll be focusing first on the numericals and then we'll be focusing on the theory. Also, everyone, I'll be sharing with you the theory PDFs which I am having. All the PDFs. Okay. Various PDFs are there and I'll be sharing them immediately. Not today, tomorrow or day after tomorrow. Okay. Or Monday, max to max Monday. I'll be sharing it by Monday. Okay. Almost there are 5 PDFs. I'll be sharing all those 5 PDFs with you. You should start revising and reading those PDFs immediately. Immediately, okay? You don't have any time to waste now. Because your first exam, this ABM is on what? 26, isn't it? 26 or 27, I think so. 26 or 27, isn't it? ABM is on 27th, I think so. Let me see. Yeah, 26th November. Okay. ABM is on 26th. BFM is on 3rd December. Okay. Then afterwards you have ABFM and this 10th you are having 9th ABFM and 10th you are having this BRPL. So you don't have much time to waste. Okay. So let's move on immediately. Okay. So now, basically you have 4 modules. Many of you might have gone through it by now because we are in the revision batch. You might have already started some studies over here. So 4 modules. Just for the summary purpose, I'll give you fast. Okay. Out of these 4 modules, module A is completely related to Forex. Module B is completely related to risk. And mind it, module B is the core because module C is totally dependent on module B. Module D is totally dependent on module B. Okay. So if you know module B correctly, this is the star performer. If you know module B correctly, then module C and D are easier for you. Module A has nothing to do with this B, C and D. Module A is totally different. Forex. Completely Forex. Okay, I'll be giving you the details. Look at this. See this. Everyone, those who are watching on YouTube, I think so. This class is available on YouTube also for the first day. 1 or 2 classes are available on YouTube. Okay. So those who are watching on YouTube, kindly subscribe to Officers Adda 24/7 YouTube channel. Also those who are in the batch, subscribe to this channel because you get various YouTube series on this channel. Click on that bell icon. And those who are watching on YouTube have not joined, join fast because I'll be sharing the important PDFs with you, handouts. Okay. Those handouts are very important from you for you. Ask the earlier students also. Those handouts are so important. Module A. Module A consists of 10 chapters, 5 over here and 5 over here, up to 10, 1 to 10. Okay. So 10 chapters, exchange rate and forex business, LRS, correspondent banking and NRI, documentary LC, facilities to export and import. Now what do you all have on in this? First, you are having many numericals in this, many. Here you are having forex numericals, foreign exchange. Here you are having LRS numericals, means LRS means limits. There are various limits to LRS. Okay. Up to 7 lakhs, that tax collected at source, up to 7 lakhs INR, it is not collected. Afterwards, it starts. So LRS, you are having that. Then correspondent banking and NRI. Here you have various correspondent bankings. Means what? Nostro account, Vostro account, Loro account, all these accounts. NRI accounts means you have all the 3-4 accounts. NRE, NRO, FCNR, then RFC. Documentary LCs. So LCs, you have various types of banks over here. Issuing bank, advising bank, negotiating bank, confirming bank, nominated bank, again reimbursing bank, various banks we have. I'll be taking this topic separately because this requires understanding. Proper understanding is required. Facilities to exporters and importers. Here you get all that pre-shipment, post-shipment finance, factoring, then various schemes of the government. What are the various schemes for this exporters and importers? What are the various trade credits available? All that. Then you have ECB, external commercial borrowings and foreign investment. In ECB, you have various limits below 3 years trade credits. After 3 years, you have ECBs, external commercial borrowings. Then various limits are there for various sectors for ECBs. That also you have. Risk in foreign trade, ECGC. Here you have ECGC schemes. ECGC has two main schemes. Remember, one is for the banks and second is for the this customers. Okay. So both the schemes you are having it. I'll be sharing you the PDFs of this. Okay. Role of Exim Bank, Reserve Bank of India, Exchange Control of India, FEMA and FEDI. So role, various roles. What is the role of each department, each institution, Exim Bank, RBI? How does RBI control the forex? What does RBI Exim Bank do? What are the various financing schemes of Exim Bank? What is this FEMA and FEDI? What is the role of FEDI? Then you have International Finance Service Center, IFSC, and GIFT City. What are these? These are all theory topics. Technology in international banking, again theory topic. Module B, again you have 10 chapters. 11 to 9, 18. Yeah, 8 chapters, 8. 5 plus 3, 8, correct. So 8 chapters over here. Risk and basic risk management framework, risk and banking business, risk regulations in banking industry, market risk, credit risk, operations risk, liquidity risk, and Basel 3. Now, what do you mean by all these things? Okay, there is a theory part. This is mainly related to numericals. Here, you get maximum numericals from module A and module B, maximum A and B. Okay, B also you have many numericals. Here you will be studying this risk regulations in banking means what are the various regulations given by RBI? What are the various limits given? Those you have to study. Then market risk, credit risk, ops risk, this comes under Basel 2 and 3. Here you will be studying Basel 2 also, and in the end you will be studying Basel 3 also. Liquidity risk management means how to manage the liquidity of the banks. What is liquidity? It's short term. Always remember, liquidity risk is always short term. Short. Okay, these are all short-term risks. Okay, then you have module C, treasury management. Here you have how many? 4 plus 3, 7 chapters. If you understand module B correctly, module C and D are very easy. Introduction to treasury, treasury products, international equity and debt products, funding and regulatory aspect, treasury risk management, derivative products, treasury and asset liability management. Now I'll tell you one important part. Chapter number 20, 21 and 24. These three are similar. Chapter number 22 and 23 related, funding and regulatory and treasury risk management. And 25, treasury and asset liability management. So this relates to all these chapters above. So that's why chapter number 20, 21 and 24 are very difficult ones. The most difficult ones are these: international equity and debt products and derivative products. Most difficult. Balance sheet management. So balance sheet means here you get components of assets and liabilities in bank balance sheet. Means asset means loans, and liabilities means deposits. So you have to study this in details. What are the various rates? What are the effects of change in rates? I'll be sharing you all these PDFs with you for theory part also. Capital adequacy and Basel norms. What are the various capital adequacy norms? Means what is the CRAR? CRAR importantly, and secondly, this CRAR as per RBI and as per the Basel. Then what are the various buffers? That also we'll be studying. Asset classification and provisioning norms. What are the various asset classifications? In the sense, how should I follow? No, Sherry, here we won't be covering the complete portion over here. It's not possible. Okay? It's not possible to cover the complete BFM portion. You have to follow the Sankalpa videos, regular batches. Here I'll be mainly focusing on numericals first. Firstly, I'll be covering the numericals over here because those are very important. If time permits, then we'll be going for the theory. And what I'll do is, for the theory part, I'll share various PDFs with you, handouts. Okay, you can go through those handouts also. And do follow the Sankalp videos, the earlier batches. Okay, yeah, because in 12 days, it's 12, 13 days max to max, I think so, we are having it. Okay, excluding that ABM days, it's not possible to cover all this theory. It's a revision batch. Okay. So capital adequacy Basel norms, then asset classification provisioning norms, liquidity management, interest rate fund. Now these are all related to theory, completely theory. Okay. So RAROC means risk adjusted risk return on capital. Risk adjusted. Now let's start with the numericals. Because here, as we are having only 12, 13 days, we need not waste our time on the introduction. Immediately we'll start with the topic. Okay. Spot rate is given as what? 75.60 and 6000 and 5500. Forward for 1 month is given as 35 and 30. 2 months is 55.50. 3 months is 85.90. Transit period is given as 10 days. Exchange margin is given as 0.15%. We have to find the bill buying rate. Now understand the firstly understand the numerical. What is it given over here? Always remember there are two rates always in market. Okay, there are two rates. This spot and second is forward. Always remember there are two rates. One is spot, second is forward. Spot means what? What whenever I buy it right now, that is known as spot. Okay, yeah. Whenever you buy at a spot rate, you have complete. You buy it at a, means like this: going in the market and buying for cash. You go in the market and you buy it for cash. Okay, so that's it. That's a spot rate. But suppose if you buy this buy something after 3 months and you are booking it now, like booking the new flat. Whenever we book a new flat, what do? We pay some margin over here, and then after 15, 20 months, that when the construction is complete, then you get that flat, possession of that flat, right? So that is forward. Forward means booking for the future. Spot means booking it right now. Okay. So now spot rate is given as 75.6055. Now what is this 60 and 55? Always remember this left side, I might have written it over here. Okay, one side. See this. Always remember left side is always buy, right side is always sell. Left side is always buy, right side is always sell. There is another name to this. This is called as bid and offer. Bid, offer, or bid, ask, anything. See here, various names are there. Buy, sell, or it can be called as, I'll write it over here also. Buy, sell, buy equals to bid, buy equals to bid, and sell equals to offer equals to ask. Any name can be given to this. Buy, sell, bid, offer, or bid, ask. Okay, it means one and the same thing. So now there are various rates. See this 60 and 55. So buy and sell. Left side is always buy, right side is always sell. Okay. So now always remember an important part. Whenever you have this right side as lesser. See this is 60 and this is 55. So there's only in the forward market, only in the forward market, not in the spot market. Whenever you have this in forward market, right side is less, then always remember the currency is in discount. See this. Whenever you have right side as less, the currency is in discount. Whenever you have right side big, now look at this 3 months. 1 month it is 35.30, 2 months 55.50. So here it is discount, but here 3 months 85.90. So here it is in premium. So whenever you have right side bigger, it's always in premium. Whenever you have left side bigger, it's always in discount. Okay. So now coming back. So this forward it's given as 35, 30 and all these things. Transit period is given as 10 days. Now what do you mean by transit period? Transit period means if I start sending the documents here, transit period is always for documents. It's not for the goods. Okay, it's not for the goods, it's for the documents. So now what happens now? If I am the issuing, firstly you understand how does this working go? Let me see if I have shown it. Okay, no. So how does this it works actually. Suppose if I am, this comes under the LC part actually. Suppose if I am the issuing bank who has issued the LC. So what happens? I have issued the LC. This LC goes to the exporter over there. Exporter prepares the goods. He sends it via ship. Now understand this. The exporter prepares the goods and sends it via ship. Let me show you over here. Okay. Exporter will send the goods via ship. Okay, generally ship. It can be sent through air also, but generally ship. And documents, this invoice and everything via air. Okay, so what happens, these documents reach earlier and these goods reach later. So this transit period means what? This document, sending this document from this exporter, he will come to you. Let's say you are SBI over here, you are the bank of this exporter. So exporter will come to SBI. SBI will send the documents to this foreign bank. Let's say it is Citibank. Citi. Okay. So SBI will send the documents to Citibank. What are these documents? There are 6 types of documents. Always remember, there are 6 types of documents. Okay. Which are those 6 documents? Those who are in the earlier batch, they might be remembering it. 2I, 2I, 2B, and PC. Right? Let me bring in a new slide. Hold on. 2I, 2B, and PC. Okay. So these are all the new export documents. Okay. 2I, 2B, PC, 2I, 2B, and PC. What is 2I? Invoice insurance. Invoice and insurance. Okay, insurance. 2B, bill of lading, bill of exchange, BL, and bill of exchange. BOE we call it, bill of exchange, or the other name to this is draft. Okay. PC means there are 2 names, packing list. Okay, and last one is COO, certificate of origin. So these are the 6 documents. Okay, these are the 6 documents. Yeah. So now look at this problem. Now here the SBI has sent the documents to Citibank, and these days require 10 days. So these are the 10 days over here, 10 days. Okay. So now look at it, 10 days over here. Now means what? Always remember, spot rate is given as 75.6055. So in spot rate, you can never ever judge whether the currency is in premium or discount. Suppose if I ask you now in this, okay, let me ask you in this. Now just look at the spot rate, everyone. Just look at the spot rate. Now can you tell me the currency is in premium or discount? Just looking at the spot rate, who can tell me whether this currency is in premium or is it in discount? Just looking at the spot rate. Don't look at the forward rate. Can anyone tell me whether the currency is in premium or discount? Right side is lower, left side is bigger. Okay? So who can tell me? This currency is in premium or in discount? No, never. You can never tell using the spot rate. Spot rate will never tell you whether the currency is in premium or discount. Premium or discount is always decided using the forward. Even if you have anything over here, lesser, bigger, anything, nothing happens. Spot rate can never give you the currency premium or discount. Premium or discount will always be given using the forward month, forward rate. Okay. So now This currency is in discount over here. Now, whenever we have a discount currency, it means the forward rates are to be subtracted. Look at this. Forward is to be subtracted whenever we have a discount. And whenever we have a premium, it is to be added. Suppose if I ask you for the third month is what? Premium. So it will be added. TT. Now remember, there are three parts you have to always remember in any forex problem. Any. One is first decide whether it's buy or sell. Second, decide whether it's discount or premium. Third, decide this TT margin, whether you have to add or subtract. So whenever you sell, you add the TT margin. Whenever you buy, you subtract the TT margin. Whenever you sell, you add the TT margin. Whenever you subtract, you buy the TT margin. Whenever you buy, you subtract the TT margin. Now look at this. What is given? Spot rate means today's rate. Today my bank is SBI over here. I have sent the document. So today's rate is 75.6055. So which one will I take? Will I take 60 or will I take 55? I want the buying rate, buy. So whenever I want the buying rate, always remember I'll take the first one, 75.60, I'll take it, 60. Next is what? 10 days. After 10 days, what will be the rate? So now that I have to take. 10 days means what? 10 days lies where? Within 1 month. 1 month is 30 days. So it will lie within 1 month. If this would have been given 40 days, 40, then this would have been 2 months. 2 months. And starting would have been 1 month. So then the range would have been 1 month to 2 months. Now it is given as only 10 days. So it is 0 to 10 days, 1 month. So what is the 1 month rate now? 35 and 30. 35 and 30. What will I take? I'll take 35. Why? Because buy. Buy means all left side. So 35 I'll take it. Now what do I do with this 35? I'll have to subtract this 35. Why? Because forward margin is in discount. Forward is in discount. So I'll subtract it. So 75.60 minus 0.35. Look at this. 75.60 minus 0.35. Okay. So my answer will be 75.25. Now look at this. Now I am having two rates. One is 75.25 over here and second is 75.60 over here. Starting and ending. Because my rates are falling, my transaction is falling 10 days. So it is falling in between. Whenever you have any transaction which is falling in between, you follow the concept of buy low, sell high. Buy low, sell high. Only when the transaction is falling in between. Okay. So now buy low, sell high. Buy low means what? Low from what? Low from these two, 75.60 and 75.25. I'll have to buy, I'm buying it. I want the bill buying rate, right? So I'll be having this 75.60 or 25. So I'll be having 25 because buy low. I have to buy at a lower price, lower of these two. So 75.25. Now what have you done? See here, there are three steps in any forex numerical. One is buy sell, second is forward margin, and third is TT margin. So two steps you have completed. Buy sell, you have decided buy. Second, forward margin, you have decided this forward rate now 75.25. And third one is a TT. Now TT is what? Whenever you are buying, you will have to subtract it. So firstly find out the TT margin. This is given in percentage, 0.15%. We don't want it in percentage. We want in actual rupees or dollars. So calculate this. 75.25, this is the rate which I will be taking, into 0.15%. So 0.15% means divided by 100. So multiply this 75.25 into 0.15 upon 100. What are you getting, everyone? Are you getting this answer 0.112? Everyone check it. Okay. Between 10 to 20 days. No. 10 to 20 days you can't take it, Muhammad. Okay. You have to take it between 0 to 30 days. Always here. The rates given over here are from the spot, then 1 month, then 2 month, then 3 month. So you'll always have to take it in the range given to you. So range given to you is what? 0 to 30 days. So take it in that range. 0 is what? Spot, and 30 days is 1 month. So you'll have to take that only. Mohammed, got it? Clear? So Jaiprakash, you are right now, 0.1128. So this is the margin you have got it. So now what will you do with this margins here? I am doing TT buying. I want buying rate, buy. So buy means subtract. So 75.250 minus 0.112. So when I do this subtraction, I'll get the 75.138. So this is my final rate, 75.138. This is my final rate to be given to the customer. And this is the end of the problem. If in exam they ask you that what is the amount is given to you, no amount is given to you. If they ask you $1 lakh, so $1 lakh into this much amount, okay? So this much amount will be. Now tell me one thing, everyone, pay attention to this. Everyone pay attention. Is this a mm, is this the this export problem or import problem? Is this the export problem or import problem? Everyone, is it a export problem or import problem? It is export, correct? Export problem. Why? Because you are using buy rate. Always remember, whenever you have buy, you always use it for export only. Whenever you have sell, you always use it for import only. Okay? Yeah. So, yeah, buy the sell I also. Mustafa, you use the same logic. Okay? Whatever periods are given to you, use that only. Okay, Mustafa. Everyone be clear on this. Okay. So, whenever Suchita, always remember, whenever you're dealing with export transaction, export, you'll always buy the currency, buy the dollars. Whenever you're dealing in import transaction, you'll always sell the dollars. Okay, remember this by heart. Okay, whenever you're dealing with export transaction, you'll always buy the dollars. Whenever you are dealing with import transaction, you'll always sell the dollars. Let's see next problem. Okay, see this next. Retirement of export bill. This is one sec. Let me convert this problem. Hold on. Where is it? Let numerical. One sec. Let me convert this problem to import now. Yeah. Retirement of import bill of GBP 50,000 by TT margin 0.2%. Ignore cash discount premium. GBP to USD is given as this. USD to INR is given as this. Compute the rate to the customer. Now look at this. What is the problem? Firstly, tell me what are the three steps I told you. First is decide on buy or sell. Buy or sell. Always follow this buy or sell. Second is forward margin. Forward. Third is TT. Okay, these are the three steps I told you. Okay, so now firstly tell me whether it's buy or sell. Is this buy or sell? Who can tell me? Is this buy or sell? What? Why don't we use 75.60? Which one? Where, Sayed? Where? Why don't we use 75.60? This one. Acha. This is Sayed. I told you now. This is buy low, sell high. You have to use the lower rate. Lower rate of 75.60 and 75.25. Lower of these two. See here, it's always buy low, sell high. This maxim you have to use always. Okay. So which is the lower rate, 75.60 or 75.25? So that's why we are using 75.25. This if this would have been selling transaction, bill sell rate. If I would have been using this sell, then I would have used this 75 point this bigger rate. Okay, got it, Sayed? Next one. Chalo, move on fast. Okay. So now, is it buy or sell? It is sell. Okay, sell. Why sell? Where is it given sell? It's not given sell. So why sell? Because it's an import transaction. Import means sell. Currency is to be sold. Now, got it? Who had asked me this sell? I think so. Shreya had asked me. No, Shuchitra had asked me. Correct? Somebody had asked me this question just now, right? So that's why sell. So now it is sell. First step is done. Second, about the forward margin. What is the forward margin? Forward margin, can anyone tell me what is the forward margin over here? What is the forward margin? The forward margin is 0. Forward margin is 0 over here. There is no forward margin. So forget it. This is gone. Step number 3. There is a TT margin. TT margin is given 0.2%. But before that, we have to get the spot rate. See here, this whole transaction is on the spot rate only. There is no forward rate. There are only two rates, remember. One is bill and second is spot. Either bill or spot. TT means spot. Remember, TT means spot. Okay. The other name for TT is spot. So there are only two rates always. Remember in Forex. One is spot. Second is forward. Only two rates. This spot can be called as TT rate also. Remember, TT margin is separate than TT rate. TT rate means spot rate and TT margin means the exchange margin which we have to pay. So now, spot and forward, got it? So now this whole transaction is on spot rate only. So now how to get the spot rate? Now TT will be dealing it later. How to get the spot rate? Spot rate is given as what? GBP to USD is given and USD to INR is given. But what do we want? We want the GBP rate to INR. Here we are dealing in Bharat. Okay. So as a Bharat country, we have to deal with GBP to India, to INR. Okay. GBP to INR. So what is the rule of GBP to INR? GBP to USD, chain rule into USD to INR. GBP to USD into USD to INR. Okay. So what is GBP to USD? GBP to USD is given as this 1.3955 and 75. So which one will I take now? It's an import transaction. Import means sell. So I'll be taking 1.3975 into USD to INR 55.0618. So I'll be taking 55.18. So now multiply this. Everyone, get the answer. What is the answer you are getting? I think so. I've done this. Yeah. 76.836. This is the answer I am getting. 76.836. Okay. So this is my exchange. 76.836. This is my spot. Okay. This is my spot. Okay. There is no forward involved in it. So everything is on the spot. Now immediately jump to step number 3. TT margin. TT is given as 0.2%. So 76.836 into 0.2 upon 100. 0.2%. Percent means upon 100. So multiply this. You'll get it as 0.153. 0.153. Now what do I do with this 0.153? Do I add it or do I subtract it? Do I add it or do I subtract it? Okay, one sec. Here I have written export, there I have written import. Okay, let me cover this. This is import. Let me cover this. This is import. Okay, import. Right? Yeah. So now what do? Do I add this or subtract this? I'll add this because import. Import means what? Sell. Import equals to sell. So what did I tell you? Import means sell. Import equals to sell. So sell means what? Add. So TT margin add. So I'll be adding this. So what is the answer? 76.836 plus 0.153. So you'll be getting something. 76 point. Are you getting this? Everyone do this. What is the calculation you're getting? 76.9 something. 9989. Isn't it? 76.989. Right? 76.989. Correct. Correct, Sherry. The rates will be different. I did this problem earlier. When I did this problem, I did it with exports. That's why this answer was 76.683. Okay. So now the answer will be 76.989. Got it, everyone? Now what you do? You take the same problem as homework. Everyone, you take the same problem as homework and do it for export. Only change this import to export. import to export, and then you solve this problem. Okay, then you should get the answer whatever I given, 76.683. You must get this answer as 76.683. Okay, yeah, 1.3975. What is this 75? Oh, one sec. Who's this? Nagasai Gupta. Nagasai Gupta. One sec. Correct, you guys. Okay. See here, this is the problem. This whole problem I had taken with export. 1.39. What is the mistake in this problem? Anyone can tell me? Only one guy has pointed it out. Nagasai Gupta. He has pointed it out very correctly. This is an error in this problem. What is that error? Who can point it out? Who can point it out? Nagasai Gupta. Very good, huh? Very good. Because why did I get this problem? I'll tell you. Because I had done this with exports. So I had done this buying. Correct? So what is the problem? The problem over here is 1.3975. This happens when you change the problem in between. Okay? So this rate will be over here. I'll do it over here only. 1.3975 into 55.18. So what is the rate you are getting? 55.18. Multiplied this, everyone? Anyone has multiplied this? Do it. Correct. Good that you pointed out. Okay, very good, huh? Very good. Now 1.3975 into 55.18. 55.18. So you're getting it? 77.114. Okay, 77 point. Let me write it over here. 77.114. What was that? 77.114. 0. Okay, forget it. That much only. Now this, yes. 77.114. Now what is this higher? Don't use this logic, Sayed. Higher to be used. No. Don't use this logic higher. Huh? Higher lower is always done in case of buy low sell high. Here you are not using buy low sell high. Remember this. Never use this this higher or lower in this. Okay, never use this logic. Buy low sell high is always taken whenever the transaction is for forward. This is spot. This is forward, some other rate, and the transaction is in between. Then you use buy low sell high. For the spot transaction, you'll never use buy low sell high. Okay. So 77.114. Now do this TT margin also. 77.114 into 0.2%. 0.2 upon 100. So what is the answer? 77.114 into 0.002, right? So 0.154. So 0.154. Now what do I do? Do I add or subtract? Do I add or subtract? It is import. So I'll be adding it. So 77.114 plus 0.154. What is the answer you are getting? 77.268. Okay, 77.268. 77.268. Okay, now you take the same problem for exports. Okay, let me remove all these things now. Erase. Okay, now you do the same problem for exports at home. Okay, take this as a homework and you must get the same answer, 76.683. Okay, now some theory part. Remember, LIBOR is no longer existing. This question will be there in exam. Remember, LIBOR is no longer existing in the world now, in India specifically. There is no LIBOR rate. Now we follow the ARR rate, alternative reference rate. Okay, ARR means what? This is a bunch of commodities, bunch of currencies, and we follow that bunch. Okay. So LIBOR and ARR. LIBOR was totally based on London rate, London interbank offer rate. That was LIBOR. But ARR is based on these five currencies. Okay. So what does RBI say? RBI has told the banks, don't use LIBOR now. Use any of these currencies or the bunch of the currencies. So why did they use this ARR instead of LIBOR? Because RBI has knows that if there is any problem now in London, if something happens in London, then what? In that case, what you have to do? Your totally all the rates will be gone. So that's why we are using this ARR. Various rates are there. Swiss average rate overnight, Euro rate, Sterling overnight, security. What is this? SOFR, security overnight financing, USD, US dollar, and yen. There are two key differences between LIBOR and recommended ARR. So what are the two differences? Important part is LIBOR includes a component of bank credit risk. Means LIBOR is given by the banks. So it will always include the bank credit risk. If the bank fails tomorrow, then what? And ARR are generally given overnight only, whereas LIBOR are for 12 months also. Whereas ARR is given only for overnight up till now. Later it will also be changed. Okay. Yeah. Mm. On 15th December, your customer presented a side bill for USD 1 lakh for purchase under LC. Transit period is 20 days. Exchange margin is 0.15%. The spot rate is 34.8090. Forward differentials are given as January 0.6557, February 1 and 0.97, March 1.4 and 1.37. How much amount will be credited to the account of the exporter? Now this, I'll give you the idea. See here, it's very simple. Same numerical. See here, customer presented the side bill. Now side bill means what? Firstly tell me, again go to the basics. Whether this is an export transaction or import transaction. Firstly tell me that, everyone. Firstly tell me that. Whether it's export or import. Okay? If no audio, kindly log out and re-log in. Okay? Yeah. So this is an export transaction. Why? Because side bill is presented for USD for purchase under LC. See this, purchase under LC. So LC means what? Purchase. Purchasing any document is always done in for the export transaction. So this is export. So once you understand this is export, immediately what must click your mind? Export means buy. I'll have to do the buy transaction now. Okay. Now, second part is whether this is forward or spot, whether this will include forward rate. So 20 days transit period is given as 20 days. So 20 days are there in between. So forward, it will be a forward rate. Okay. And last one is what? TT margin. All the three components are there in this problem. Exchange margin is given as 0.15. So now use this. Buying rate will be applied. Why? Because it's an export transaction. What is the spot rate? Spot rate is given as what? 34.8090. So which one will I take? I'll take 80. Why? Because buying 34.80. So 34.80, and what is the currency given? 0.65, 0.57, 1.97, 1.4 and 0.37. So now this is 20 days. 20 days means what? It falls in 1 within 30 days. So if it falls within 30 days, let me see if I have drawn this. Yeah. See this. This is 20 days. So whenever it's falling in 20 days, it means it is within this 1 month rate, 1 month duration. Okay. So whenever it's given in 1 month duration, now tell me one thing. 15th December, and this is January rate. January rate is given as 0.65. Now what do you mean by this? Don't you find something weird over here? See this. January, whenever the rate is given of January, it means it's of the January end. Remember, it is of the January end. Okay. So the January rate of 0.65 will be applicable at the end. Over here, it will be applicable. Okay. It will be applicable over here. But what about this transaction is happening when? This transaction is happening 15th December plus 20 days. So 15 plus 20. So 15, 25 December and 5th January. So it is happening on 5th January. So if it is happening on 5th January, what does it mean? If some transaction is happening on 5th January, so it is happening between the month, between somewhere in the month. So I'll be applying buy low sell high. See this BLSH. I'll be applying this buy low sell high over here. But for comparing this buy low sell high, I need to have two rates. How do you compare? Whenever you compare, you need to have two rates. One is January end, you are having it. See this. The January rate which is given to you, this is of the January end. So this rate is January end. But what about the January start? You don't have the rate of January start. Is it given somewhere? No. But the rate is not given. What does it mean? I need to take some rate. So which rate will I take? I'll take the December spot rate. Whatever was the 15th December spot rate, I'll be taking it 34.80. Same rate will be carried forward to this January end, January 1st. Okay. So January 1st, I'll be carrying the same rate of 34.80. Remember, everyone pay attention. Everyone pay attention. Very important one. Whenever the rates are given, always remember one basic. The rate given to you is always of the month end. Suppose if January rate is given, it is always for January end. Whenever February rate is given, it is always for February end. March, it is always for March end. But if it is at the end, what will I do in the middle of that month? January end. What about the January start or middle? So I'll be using the earlier month rate. What is the earlier month rate? For January, January month, I'll be using earlier month. What was the earlier month? Earlier month rate is December, right? So December, this rate, I'll be using it for this December end now. Now you'll ask me one important part. What about the December forward rate? December forward rate is not given over here. See here, actually they should have given something like this. They should have written it over here. December, then they should have written as 0.5, 0.4, something like this. They should have written it. December 0.5, 0.4. So then it means it's for December end. But it's not given. Suppose if it is not given in exam, I'll write it over here and show you. Okay? See here. They should have given it over here forward differentials. December. Then they should have given you 0.5 and 0.4. Something they should have given it like this. Then you would have taken over here the January start. Then you would have taken December end rate. So you would have taken 0.5 over here. Okay, buy. Okay, but what has happened? They have not given this rate. So if they have not given this rate, take the earlier rate 34.80. So use the same rate over here 34.80. Then now the comparison is between this and this. These two you are comparing, right? This one and this one. So now the comparison is between 34.80 and this 0.65. What is this 0.65? This buy rate. This is in discount because the right side is lower. So if this is in discount, I'll be subtracting it. So what am I doing? 34.80 minus 0.65 minus. So I'm getting it 34.15. Okay, 34.15 I'm getting it. Now what will I do? Buy low, sell high between these two rates, this one and this one. So which is the one which I'll be taking? 34.15. Why? Because it's a lower rate. So 34.15, this is my second step rate. Here, there are three steps. One is buy or sell. Second is forward margin, right? Forward. And third one is TT margin, right? TT. So this step is still remaining. So after this forward rate, I've got 34.15 as my rate. Is this my final rate? No, I have to still follow this step. So now what will I do? I'll take this TT margin again, 0.15%. I'll multiply this 0.15% with 34.15. Look at this. 34.15 into 0.15%. So I've got this answer as 0.0512. So I'll subtract this now. 34.15 minus 34.15, I'll write it directly over here, 0.15 minus 0.0512. You must get this answer. 34 point, what is the answer you're getting, everyone? 5 minus 5 is 0, 4, something, 34.09. This answer you might be getting, 34.09. 09, isn't it? Yeah, correct. 34.09 and something more. 10 minus 1, 9. 0.34.099, you will be getting something. Okay? Correct? Now, Shuchita, you got it. Why applicable in 15 December? Because the rate for the December end is not given. That's why you are using this 15 December rate. Okay? Now, I'll ask you one question. Everyone, I'll ask you one question for homework. Okay? Take this same problem. Everyone, I'll upload this PDF. Huh? Take the same problem and I'll give you one different try over here. One sec. Let me remove all these things. So everyone has got this over. Yeah. Yeah. Now what will I do? I'll add something more in this. What will I do? I'll add this December rate also. December. And this I'll add it now. 0.55 and 0.45. 5 minus 1. Yeah, 45. Okay. This is December rate given. This is 80. This is this. This is this. Now you all do it as a homework and then give me the rates now. Will there be any change in this? Let me check. 34.8050, 35.865. Yeah. Will there be any change or are you getting some different answer? Give me the answer tomorrow, everyone. Okay? Give me the answer tomorrow. I have given you this as a homework. So there are two things for your homework now. One is this, and then there was one problem earlier also. Okay? Got it? Let me see some other numerical. This is all theory. Okay, let me cover some theory part also. Yeah, this. Everyone pay attention. What is this pre-shipment and post-shipment finance? Many of us don't understand this. Pre-shipment means what? Before. Pre means what? Before. Before the shipment. Means what? Suppose if I get some order, let's say I am an Indian exporter, okay? I get an order from USA that, okay, supply us 1,000 plastic chairs or 1 lakh plastic chairs. Supply us 1 lakh plastic chairs. Now for manufacturing those 1 lakh plastic chairs, I'll be requiring money because raw material is required. So that raw material is provided through pre-shipment finance. Pre-shipment finance is always provided for raw material. And then once I prepare those chairs, I'll be putting them in the ship. Look at this. I'll be putting them in the ship. Let me show you. I'll be putting them in the ship and this ship will move to USA, buyer. So this is known as post-shipment. Always remember, pre-shipment finance is given 75 to 80%. 75 to 80% of the order amount. Okay, and that also on FOB basis. Let me see how, where have I written? Yes, this part. Pre-post packing manufacturing 85%, this end use tracked. One more point which I have not written over here, that is FOB. Pre-shipment is always given on FOB basis, free on board. So remember, pre-shipment is also called as packing credit. It is given for manufacturing of the goods. Look at this. It is given for manufacturing of the goods. It is always given 85%, max to max, 85%. End use of the funds is always tracked. End use of the funds is always tracked in pre-shipment finance. And it is always given on FOB basis, free on board. Post shipment finance, it is not packing credit, it is given full amount. Means whatever is the export order, complete 100% amount of finance is given in post shipment. No end use of the funds is tracked. It's not necessary for tracking the end to you track the end use of the funds. It is not given on FOB only, it can be given on any Incoterm. NTP is generally 25 days. Normal transit period. Generally it is 25 days. 25 days means for sending the documents from SBI to Citibank USA. This, remember, NTP is only for days, for documents. It is never for goods. Okay? Yeah. So buy or sell, this done, this done, this done. TT margin already given. Yeah. This already I've told you 2I, 2B, and PC. Okay. Now one thing I'll tell you about this 2I. Okay, everyone. What is this 2I, 2B, PC? 2I means what? Invoice insurance. Who prepares this invoice? Invoice is always prepared by the seller. Insurance. Insurance is always prepared by the insurance company. Bill of lading and bill of exchange. 2B. Bill of lading, bill of exchange. Bill of exchange is always prepared by the seller. And bill of lading is always prepared by the shipping company. It's like the ticket. What is bill of lading? Bill of lading is a ticket. Ticket given by the shipping company. See this, I'm having this material of this guy. That is basically, when suppose if you send some bike of yours, bike, car, anything. Sometimes we send the goods via train. Bike, we are shifting from one city to another. We send it via train. So that train person gives you that receipt that I've received this bike. That is basically your BL. Okay. 2B means bill of exchange. What is PC? Packing list and certificate of origin. What is packing list? Packing list means, suppose here the ship, this, let's say this ship, whenever this ship is arrives on the port, this ship arrives on the port. This ship is so big. Where have I kept my material? I don't know. So this packing list gives me where in this ship have I kept this material. It's like that railway ticket. Okay, railway ticket. Handouts I'll be giving you, Madhu. I'll be giving you the handouts on Monday. Okay, all of you. I'll be giving you the handouts on Monday. Okay, those who are on YouTube also, kindly remember, join the classes immediately, because I'll be distributing the handouts on Monday. Okay, tomorrow is what, Friday? Yeah, Friday, Saturday, 2 days are there. So join it today itself, because tomorrow also important topics will be taken, and mind it, they won't be repeated. They won't be repeated because hardly we are having 12, 13 days in our hands, right? So we'll be revising it as fast as possible. Okay. Yeah. So coming back, packing list and what was that CO? Packing list is like that railway ticket. Suppose if you are going on a railway station to collect your some of your relatives, do you search the whole train? Go on searching from start to end of the train. Do you search that? No. We having that ticket. We know that ticket. Bogie number this, seat number this. That is the same thing in packing list. The packing list means that ticket only. Okay. So now certificate of origin. Certificate of origin is always prepared by the this Chamber of Commerce. What is Chamber of Commerce? Chamber of Commerce is a respected unit, respected part in the society. Some 15-20 respected persons in the society come together and they form the Chamber of Commerce. So there are very less chances that these Chamber of Commerce will give you some false information. Okay, got it? Now one more point. As we have come on this topic, let me explain you this topic something more. Bill of exchange. Bill of exchange will always be of two types. Always remember. One is sight and second is usance. Sight means immediately, immediate payment. Pay on sight. Usance means future date. As we have used this 20 days transit period, 30 days transit period, that is all usance. Whenever you get the payment on the future date, in that bill of exchange also it's mentioned. Future dated transaction. Usance means on that bill of exchange it will be mentioned. pay after 30 days from this bill of exchange. So that is usance. There is a next payment system that is called as deferred payment. Deferred payment means what? There is no bill of exchange involved over here. No bill of exchange. It's purely in deferred payment. You don't have these 6 documents. You have 5 documents. 2I, 1B, and then PC. Only 1B you have because bill of exchange is not there. There's only bill of lading. Okay. So that is deferred payment. Okay. Chalo. Bye for today. We'll be meeting tomorrow again. Okay. Bye everyone. Okay. Got it, everyone? Understood the topic which was told to you, and everyone, others, those who are watching on YouTube, those who are watching this free class today, kindly note how to join the classes. I'll tell you, everyone, join the classes ASAP because once you miss out this topic, you won't be able to get it again. See this, go to Adda 24/7. Everyone, go to Adda 24/7. I would suggest you to download the app first. In the app, you're getting the coin systems. Using the coin systems, you'll be getting 1% extra approximately. So click on this revision batch, November, CAIIB November 23. Click on this November. Okay. Now you'll see this English batch. Click on this English. Powerpack revision English batch. Look at the fees. 80% off is going on. 2,999.80. Only this much fees. Click on prep 80 code already applied. Click on buy now. Buy now. Look at this 80% off. Okay. Enter the code. Even if it is applied, don't enter it. Okay. Continue. Fill in your details, full name, phone number, email, and done. Important point, remember what you get in this. Those who have joined the class, you also pay attention. Ebooks, look at these ebooks, read these ebooks. Though you have just purchased them, but you don't read it. I say you should read these. Subject wise, they are given. Click on this subject. You're getting chapter wise. Each chapter wise ebook is available. Those who have purchased it, go through it, start reading it. Okay, very important ebooks are given. Tests are there. If you can apply for test, go through at least 2 tests. At least apply for 2 tests. Okay, I don't think all of the tests it'll be possible for you to go through it now. Okay, at least go to 2, 3. That's also enough. Okay, so join this batch immediately, everyone. Those who are on YouTube, okay, join it immediately because you are getting these ebooks, tests. Then, as you can see right now, students were asking the questions over here itself. So immediately doubts will be clarified. Okay. Chalo, bye everyone. On Monday, I'll be sharing the handouts. Very important handouts. Okay. Chalo, bye. Don't forget to give the ratings at the end. Ratings are very important from the management point of view. Okay. Chalo, bye.